everyone, my name is Jenny Princess Tolentino from BSBA FM2A. We are Group 6 and we are going to discuss about Module 6, Accounting for Receivable and Bad Debts. These are the contents of what we will discuss in this video. First, the introduction of accounting for receivables and bad debts. Second, estimating bad debts. Third, writing of accounts. Fourth, the direct method and alternative approach. The fifth is what happens when written off accounts are later collected. Sixth, the aging of accounts receivable. Seven, sales returns and allowances. And the last is analyzing receivables. So let's start. I'm going to discuss the introduction of accounting for receivables and bad debts. So when we say accounts receivables, customer owe money to a corporation for goods or services they have received but have not yet paid. For example, when customers purchase product on credit, the amount owed gets added to the accounts receivables. The word receivable refers to the payment not being released. This means that the company must have extended a credit line to its customer. Usually, the company sells its goods and services both in cash as well on credit. When a company extends credit to the customer, the sale is released when the invoice is generated, but the company extends a time period to the customer to pay the amount after some time. The time period will vary from 30 days to a few months.
Hi, this is Gerald from group number 6. I will be the one to discuss to you how to estimate bad debts. Let us first discuss what is bad debts. This way, it will be easier for us to understand bad debts and why is it important to find its estimated value. Bad debts means a debt that cannot be recovered. These are credits from the company that are uncollected or remaining to be receivables. It is important to estimate bad debts because it is impossible to measure a specific value of bad debts expense of the company due to the reason that a company cannot control how or when people is going to pay their debts, meaning it is out of the control of the company itself. Moving forward, there are two methods to estimate bad debts. The first one is by percentage of sales. The debts or the bad debts is estimated to the anticipated credit of the company from their past records. Let's say, for example, a company ended their last operating period with 1% out of 100% sales to be uncollected. In the next operating period, the company will assume that that percent will be the same percentage or estimated value of bad debts that they will be encountering to their about to end operating period. The second method is by the percentage of their receivables. The percentage to use varies using still the past records, but this time from aging or using the aging schedule. Also, it is now doubtful or it is now or includes now the doubtful accounts as shown on the screen. The record will be the same entry in the book. The additional credit will just be added to the existing record on the book or will just be adjusted. For example, there is already an existing 175 debit, and in order for us to record a new credit, we will just be adjusting the existing doubtful account by simply adding them. Let's say, for example, it is $372. You can see them on the screen, and that would be all for estimating the value of bad debts.
Thank you, Mr. De Luna. So now let's move on to the last part of this discussion, which is all about the writing of accounts, and second is what happens when written off accounts are later collected. Writing off account. Write-off is an accounting action that lowers the value of assets while simultaneously debiting a liabilities account. It is primarily used in its most literal sense, seeking to account for unpaid loan obligation, receivables, or losses on stored inventory. So it means ito yung pangunahing ginagamit sa pinaka-literal o literal na kahulugan ng mga negosyong naglalayong o gustong i-account yung mga hindi nababayarang obligasyon o pautang, yung mga hindi nababayarang receivable o mga pagkalugi sa nakaimbak na inventaryo. So in general, it can be broadly defined something that helps to lower the annual tax bill.
Hello everyone, my name is Aladin M. Ilog, and I will report to you the direct method, an alternative approach. What is the direct method? The direct method is one of the two accounting treatments used to generate a cash flow statement. The statement of cash flows, direct method, uses actual cash inflows and outflows from the company's operations, instead of modifying the operation section from accrual accounting to a cash basis. Accrual accounting recognizes revenue when it is earned versus when the payment is received from a customer. This method is called the direct method because it calculates the net cash flows from operation in a much more straightforward fashion than the indirect method. The direct method uses a simple income statement style approach by adding up the income and subtracting the expenses. This is a pretty common sense way to present this section. The direct method reports the total cash inflow or outflow from each main type of transaction, that is, transactions with customers, suppliers, employees, etc. The difference between these cash inflows and outflows equals the net cash provided by operating activities. Example of the direct method for the statement of cash flows included in the operation section include the following: salaries paid to employees, cash paid to vendors and suppliers, cash collected from customers, interest income and dividend received, and income tax paid and interest paid. Example: cash flow from operating activities. Cash receipt from customers, 1,500,000. Wages and salaries, minus 450,000. Cash paid to vendors, minus 525,000. Interest income, 175,000. Income before income taxes is 700,000. Interest paid, minus 125,000. Income taxes paid, minus 237,500. And the net cash from operating activities is 337,500. Both methods will arrive at the same number, but they are presented differently. The direct method actually lists the major cash receipts and payments on the statement of cash flows. For example, cash receipts are often listed from customers, commissions, and tenants. Cash payments are usually broken out into several categories, like payments for inventory, payroll, interest, rent, and taxes. Categorizing these inflows and outflows can be time-consuming since they are not categorized like this on any other financial statement.
So next is what happens when written off accounts are later collected. Bad debt recovery is a payment received for a debt that has been written off and is deemed uncollectible. Here recipients can come in the form of a loan, line of credit, of any other account receivable, because it generally causes losses when it is removed. Bad debt recovery often brings in profits. It means dito yung parang maaaring dumating yung mga recipients sa inyo ng isang loan and line of credit o anumang iba pang accounts receivables. And dahil ito nga yung pangkalahatang nagdudulot ng mga pagkalugi kapag ito ay inalis. Also, ito yung pagbawi ng masamang utang na kadalasang nagdudulot ng kita or mas malaking kita.
The aging of accounts receivable. What is an account receivable? The accounts receivable is the proceeds of payment which the company will receive from its customers who have purchased its goods and services on credit. Usually the credit period is short-ranging, from a few days to months, or in some cases, maybe a year. Accounts receivable aging, tabulated via an agent receivable report, is a periodic report that categorizes a company's accounts receivable according to the length of time an invoice has been outstanding. It is used as a gauge to determine the financial health of a company's customers. The accounts receivable aging shows a company's receivables are being collected much slower than normal, then this is a warning sign that the business may be slowing down, or that the company is taking greater credit risk in its sales practices. The formula: aging of accounts receivables is equal to average accounts receivables multiplied by 360 days over credit sales. The accounts receivables are based on sales which are done in credit. The aging accounts receivables are calculated by multiplying average accounts receivables by 360 days. Instead of multiplying it by 365 days, which are the number of days in a year, is done to avoid fractions in the calculation of aging accounts receivables. Then this is divided by credit sales. Example to calculate accounts receivable aging. Miss Michael has accounts receivable for 5 million on April 1, 2018, and accounts receivables for 4 million on March 31, 2019, and it sold the goods 9 million on credit during the financial year 2018 to 2019. The formula: aging of accounts receivables is equal to average accounts receivables times 360 days over credit sales. Aging of accounts receivables is equal to 4,500,000 times 360 days over 9 million. Aging of accounts receivables is equal to 90 days. In above example, accounts receivables are calculated basis opening and closing accounts receivables divided by 2. 5 million plus 4 million divided by 2. The entity receives payment from accounts receivable. Average is 90 days. An AR collections aging report provides important data on customer payment behaviors and the effectiveness of crediting or collections functions. Running an AR collections report regularly, usually weekly or monthly, helps you understand what to expect from customers in terms of payment. It also identifies cash flows issues before they become problems. Cash flow problems usually relate to collection policies or customer behavior. Certain clients may be delinquent more often than others. AR aging reports provide concrete information that can be used to take action. A good example is making the choice to withhold services for clients beyond your payment grace period. Finding the right balance between grace periods and service restrictions is easier with regular collections reports. It ensures you don't lose money providing services that will never be paid. An aging report also analyzes how your customer's company works. This ensures your invoicing processes are aligned with their accounts payable.
Thank you, Mr. Ilog. Next is sale return and allowances. Whenever sale product to customer, there are always going to be a chance that the customer is dissatisfied and is going to want their money back. In the accounting world, we call this either a sale return or allowance. Sale return is when a customer sends a product back to you, a request or refund of the amount paid. This might happen because the product is dysfunctional or broken in some way, or maybe they're just unsatisfied with it. Allowance is similar to return in that customer requests a refund but with an allowance. The customer is not expected to return the product, they just get their money back. So next, Mr. Luna.
Moving on to the next topic, we will be discussing the analyzing receivables. First, what is receivables? Receivables are the amounts that customers owe to the business for goods and services that are already provided. It is important to analyze receivables because it will help the company's investors to gain a better sense of company's overall financial stability and liquidity. There are also benefits of analyzing receivables. It includes more sales from reliable customers, meaning that the customer will order more products one time because the cost will incur in the future. And for the lower cost, it will also help the company to lower the cost on transaction due to customer tending to order more in credit. The other transaction to be made in the future will be covered in just one particular transaction, which means lowering the transaction costs. The only problem that can be seen in two receivables are those money owed by unreliable customers. These are the customers that are not paying their debts to the company in a particular given time, which forces the business to accept loss. Those assumpted amount to not be paid are termed by accountants to be the allowance for bad debts. There are different ways to analyze receivables. The first one is using the receivable to sales ratio. This ratio consists of the business accounts receivables divided by its sales. It allows investors to ascertain the degree to which the business's sales have not yet been paid for by customers at a particular point in time, which will help the company or which will help the business to avoid future same scenario and lessen the receivables with the next accounting period. The other way to analyze receivables is by examining the manner in which business allowances for bad debts has changed over time. If the allowance for bad debts has grown substantially, the business may suffer from a structural deficiency in regard to its ability to collect payments from its customers. Helping the company, it helps the company to create strategies to either better way of collecting receivables or avoiding specific period of time that receivables are more likely to be incurred. The results in analyzing receivables may suggest that if the ratio is high, it will suggest that the business is having difficulty in collecting payments from their customers, which will also, connected with strategizing better ways of collecting receivables from the customer. Again, the mentioned ways of analyzing receivables are first by using the receivable to sales ratio, and the second one is by examining the manner in which business allowances for bad debts has changed over time.